Good evening, everybody, and welcome to today's market report. So usually I do these reports on Sunday evening, but I'm actually headed out to a cruise, so I'm not going to be around for a whole week. I have to enjoy myself a little bit, but I'm not going to leave without giving you a more detailed view on the markets. Of course, this is all just my opinion, and we can be wrong every once in a while, so do your own research. Now, of course, I was wrong recently. I picked up some VIX, and didn't quite work out the way I wanted it to work out. But nonetheless, there's always a plan B, and my plan B is to pick up some more. So I've been adding. I guess I would call it repositioning myself. And sometimes you have to be adaptable when you're a trader. So I've been repositioning myself into some other vehicles. I've been going into options, and I'm very picky about my options. So options, I don't buy them just when whenever I feel like it. I buy them when I absolutely think that they're gonna move. And again, with options, you have to do that. Options, even if the market is moving in your directions, options may not be moving in that same direction, again, because they do lose their value in premiums. But regardless, what I want to say is the market had an excellent day. However, and as any trader should, it is entering danger zone territory. I ideally was hoping for some sort of pullback, and I think that we will get it. But if it keeps trading like this, it's actually not good for the markets. And again, think about all the times when we've had major market crashes. They came right after extreme euphoria, right? And if you were following any of the news media today, or even people in general, there was a little bit too much euphoria for these markets. Yes, we've had this amazing move higher intraday. We gapped down, went lower, and then ultimately surged higher. So overall, it was pretty good. But when you add it up, it wasn't really that much. So if the market goes up 0.6%, you shouldn't have the media out there screaming, I don't know what kind of headlines they had, but they had extreme euphoria. And then, of course, as if that wasn't enough, all the common people, I guess for lack of a better word, the retail traders and the like, we tend to get swayed by it. And we say, well, okay, this thing is never going down, right? Well, the moment you say that, that's when it happens, right? So remember, we kind of had the same situation around Christmas. Janet Yellen came out and she said, we will have patience. And who knew that one word could drive the markets up like that? And then, of course, right after Christmas was done, we tanked. And so you have to be careful around times like these. When everybody gets euphoric, you have to be very, very cautious. As far as the wording out there, as far as the way that the media covered it, it was a little bit too much for a market that only moved 0.6, 0.7%. It should have been a regular day like any other. It should not have been a day that was hyped like that. And again, this was all in terms of what happened in Greece. But you have to kind of take yourself out of the picture, and you have to cool your mind, and you just have to look at the facts. Okay, so Greece got a 4-month extension to pay a debt. I don't know how they're going to do that, but it wasn't like the debt was erased. It's still there, and they're going to have to come back in 4 months and somehow start paying it off. And then the market really was up only 0.6, 0.7%. So if you take the media hype out of it, it was just a regular day where the market rallied a little bit higher after a gap down after the situation in Greece was resolved. And that's it. I don't see anything more than that into it. So it was hyped a little bit too much, and when you see media hyping things like this, you have to become cautious. Now, we are into a ton of resistance, and let me show you what we have here. So let me go back to the 120 chart, and I want to stress this chart. And again, I did some numbers after hours, and I looked at a couple of things, and it appears that the most bullish of the charts is actually the 120-minute chart. And I know that, usually people think about the market in terms of fractals, so it's either the shortest time frame versus the longest time frame, but sometimes you have to be a little bit adaptable. So here, the most bullish time frame, based on the numbers that I have, is the 120-minute chart. And so if you come back next week on Monday and Tuesday, make sure to pay attention to the 120-minute chart, because that is the bullish chart to beat, so to speak. And so that is the chart that is going to have to, the time frame that is going to have to give you some sort of signal that we will be reversing. So that's my first advice. Now, if I look at this particular chart, so again, we're looking at the SPY as always, in case you're new to my videos. What we have here is major resistance. So if you take, let me see here, these windows are always in my way. If you take this line right here, and even this pivot right here, around November 21st, and you just start connecting, notice how many lines it goes through, or how many rather candles it goes through. We are right into resistance here, right into resistance. However, it has been hitting this a couple of times, so I guess you could say this is the first time, although you could also argue it's been hitting it 3 times. But either way, I look at it in a more of a macro scale. So first time, second time, third time. Now the question is, do we reverse lower or do we go higher? Okay? Stochastics and the CCI are telling us that we have overbought conditions. And we also have this print right here that has shown the high to be 112.97. So, which one is it going to be? Around this area, do we sell off now or do we have a little bit more upside? So, this is your first resistance, this blue line I drew in. Then you have this print right here. You also have a little bit of a fib retracement. So if I do a fib and I choose this high right here, which was the December 29th high, and if I draw it all the way to that infamous pivot we had right before the Christmas rally, you will notice that we also have a 1.272. And if you know a little bit about fib extensions, you know that this fraction is very important. It's also a whole number. Again, so what are the resistance levels? Well, for one, the level where we are already. Second, that 212 level. And third is the fake print, which is at 212.97. So let me try to write that for you guys. So here are the levels. Okay, you may want to pause and write them down. Now, one particular level is the 212 level. Okay, and again, of course, you can look at it as also being this level, which actually makes it even stronger now, right? We have 2 reasons why this 212 level is key. Again, one of them being this fib level and the other one it being a whole number. But let's look into this whole number idea. And let's do a little bit of a testing. Let's go and back test some of the times where we've hit whole numbers. Look at this candle, right? And all the ones right next to it. Notice how it was difficult to get above 210. Then look at this one right here. A little bit of support into 209. Then you had a window right here, basically from 207.60, but notice where you open at 208. So again, another whole number. Also 207, a pivot. 206, a pivot. Okay, then here goes another little bit of a window right here. Okay, then you also had the 204, which was almost tagged, but here it was actually serving as support. Then notice these windows, right? 203 to 202, a whole dollar difference. Then you go back here. Remember how we were always talking about the 199 level. If we break below 199, well, because it was an even number, right? It was a whole number, not even number, right? That was important. Then here, notice the low here was also a whole number. Okay? And I think I'm making my point clear here. So anywhere you see these faded gray lines is a whole number, okay? So you can do your own research there. Same thing here, 209. Then here we went a little bit above 206, but either way, here goes another $206 level. 197, 206, and again it goes on and on and on, and you can even go back here and you will find how wherever we have these gray lines, the market tends to either pivot or stall out or do a quick jump, okay, to give us a gap window right there. So notice also here 182, even number. I keep saying even number for some reason, whole number, okay? Then notice here, here, here. How beautiful is that? From a whole number to another one, to another one, to one here, here, okay? So it seems like we're making these swings between whole numbers. Now again, nothing is perfect, so you're not going to say, well, hey, you know, I found one where it isn't. Of course, nothing is going to be perfect. But that's what I'm seeing. And then in addition to that 1.272 level, which is the 211.99, which is only 1 cent short, it appears that it might be a very strong resistance. So if next week we get into that level, look into it. Now for the longer term investors, let me give you my perspective of what's going on. So for that, let's go to the daily, and I'm gonna have to make the chart a little bit smaller to make my point. But essentially what's been going on is that we have been trading in a channel. That's it, and we are still within that channel. So again, this is why all that bullishness is sort of all that hype and all that bullishness is a little bit too much for my liking. And so if you go back and you connect some of these lines right here, so let's just go here and connect this one right here. This is your lower edge of the channel, and then next you could connect this right here and try to connect most of the points. Okay, so yes, the channel goes back very far, right? So I drew this line to November 2012 and this one to September 2012, but guess what, it goes down even further, right? That is just one little area of it, right? So if you connect this one right here, you will notice that it goes all the way down to where our economy essentially broke out in 2011. And even more interesting is the upper line, because that one you can draw even further, right? Even further out to guess where? Right here. This pivot from 2009. So, this is where we kind of had our first little reversal, and then after 2011 we blasted off to the upside. And so if I just switch back to the weekly to make this a little bit more visually appealing, okay, so again what we're seeing is that we're just in the context of the market, we are in a channel, and that's it, nothing else to it. Not sure why we have all that bullishness, or at least that bullish sentiment out there. So we still haven't even tagged the upper edge of that, okay? So the idea being is that, yeah, you can kind of trade around maybe into 215 at the most, but eventually the market is telling us that it's still in this channel, and it's innocent until proven guilty, and therefore we have to assume that it's going to trade in this channel unless it proves otherwise. Now I do want to show you some things here. So let me again erase these lines, and for this we're going to go to the monthly. And now we're going to take an even larger view of what's going on. So again, history tends to repeat itself. The market tends to trade in fractals, and it does repeat a lot of what it has done before, and sometimes you can divide that into self-similar, I guess, small little sections. So having said that, let's try to do that. So if we go to, I guess, this middle section in the markets, so if we go from October 2002, exactly, well, not exactly, but about almost 13 years ago, to October 2007, and we draw a line, right, from here to here, and let's pick up this line and superimpose it on the markets today. Okay, let's put it on that pivot from 2009. And what you can do is you can draw some fib levels from that line. And what the market tends to do is repeat moves. So in other words, it could have done this exact identical move, and it could have gone into this top to make it a triple top, but it decided to go further. And so what we need to do is we need to look at certain percentages to see how far it might get extended beyond this oscillating move right here. So if we do a fib retracement, and if we try to also add extensions to that, which in my case are already built in. So again, these are the most important fib extensions that I use. So that's for that move right there, okay? So what you'll notice is that a lot of times, wherever we had these fib extensions or retracements, there was a pivot in the markets. So if we zoom in, you'll notice that, okay, here was your 0.382, okay, there was a little bit of a pivot right there. Then the 0.5, there was a pivot right there. 0.618, there was a pivot right there. 0.786 overshot a little bit here, and here it actually tagged it. Okay, moving on. Here 0.886, here was the 1 times or 100% move. Then also notice here also a little bit of a level, then here a little bit of a level. Okay, here it kind of struggled a little bit, but if you actually look at this current month, which is the February month that we're in, it actually did come within this 196.97 level right here, And if we look at the candle for February, the low was 197.86, and in January it was 198.55. So again, it came near that. Nothing is perfect, as I said. So here's the idea. Okay, based on that Fibonacci extension move, it seems that there have been pivots around these areas. Now again, nothing is perfect, but we do see a little bit of a push and then a pullback, push and a pullback, and then we kind of trade in between. Okay, so now the question is, what are we going to do now? Now we are into the 1.786 level. And the question is, do we go further? I highly doubt it that we're going to get there anytime soon, because again, look at these stochastics and the CCI. They're actually looking like they want to weaken. But again, we still have a long ways to go until February ends, so we have to look at this chart again on the very last day of February. But either way, it appears that the market is struggling here. So let me take off these arrows for now. Let me see, do I have more? I do, I have a ton of them. But I'm going to keep the fib retracements. Now, let's strengthen this argument a little bit here. So, this blue line right here was a superimposed line from this move right here. But what about this move, right? We can do the same thing with that. So if we just kind of pick this area right here, and again, it's a little bit difficult, you know, because look at where we were trading. But either way, I'm still going to use it. And we're also going to superimpose this line right here. And we'll do the same thing. Do another fib. Okay, maybe this one I'll pull off to the left so that they don't coincide. Okay. So what I want to do now is I'm going to highlight any areas where they were sort of within each other. And one thing I forgot to add was the 1.5. So let me do that off to the side on my other screen, which you cannot see at the moment. Give me 1 second. And I'll make that one green. There we go, it appeared. So there goes your 1.5. We'll do the same here. I usually don't use the 1.5 in my fibs, but sometimes you have to add them on and use them as well, especially in these kinds of ranges where you're looking at things in more of a trending pattern. So did I add it? Let's see here. I believe I did. Yes, I did, so it's somewhere on here. Okay, so the idea now is to add, or rather to highlight, any areas where both of these fib levels were kind of within each other. In other words, where they almost overlapped. I'm going to use a rectangle tool for that. Here we had some overlapping, okay? Then we had some overlapping right here. We had some right here, right here. And my point here is that we're actually into such a level now, okay? So let's review what happened there. Why is this important? It's important because every time these two fib lines of any level coincided, there was a little bit of resistance or support there. So notice how here we came back and there was support. Then we went back, we went back up, we went into this level right here. Sold off, guess where we found support, right? So this move essentially you could have predicted just based on fib levels, right? Moving on, here was a little bit of a level. Notice how here we struggled. Moving on, here we struggled. Notice how we came back, found support at this level. And now we're finding one such level. Again, the 1.786, but then also the 1.272. Now, the 1.272 is a very, very strong level when you're doing fib extensions. Notice that's what I showed you in the 120-minute chart at the beginning of the video. And now we're actually seeing it on the monthly. So again, this 209.54, 210 area seems to have a lot of resistance at the moment. Okay? So if I zoom out and I show you that, and I take off all these funny lines and these fib extensions so you're not confused, and I just leave the blue lines, or the blue rectangles rather. Okay, so we had one here, 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 and here. Notice how there's sort of a pattern here, right? So support, bounced here, support, moved higher, found support, or rather resistance here again, a second time around, moved higher, there was a little bit of resistance right here, and then a couple of months later that was also support, moved higher, same situation right here. And so the question now is, are we seeing that right now? So let's look at another aspect here, and for this we have to go to the daily chart. Okay, so I set out and I looked at the recent whipsaw we've been having in the markets. As we all know, since the end of December, we've sort of been trading in this range, and of course now we're breaking out and everybody's bullish, right? We got all the hype. And what I sometimes like to do is I like to calculate just how far price is able to move. So based on this, as an example, we can say that the max that price moved was this right here, this area. So in other words, we went from this pivot to this pivot. And so let's test that hypothesis. In other words, let's try to find whether or not this is a common occurrence. So if we go back and we superimpose this arrow onto certain resistance, we want to see whether it spanned across resistance and support. And here it did. Okay. Going back, we can do the same thing. Now of course it's not always going to be perfect, like anything. Nothing is perfect. But notice how here you had the top here and then the support was right there. Moving on. Okay. Notice how here, if you did it here, you could have figured out the top for this move was right here. Then the support was this area right here. Okay. And sometimes it's not going to be perfect, as I said, so sometimes you're not going to be able to find it. But again, here's your top, there's your support that was found later. Here you can use it, top, bottom. Top, bottom. Top, bottom. And again, I want to be detailed here, so if you want to fast forward, by all means. Just want to show you how many of them there are, so you're not going to miss anything if you fast forward a couple of minutes. So here, top, bottom. Okay. Again, you can keep doing this. You're going to see top, bottom, support, resistance, right? So here's your top right there. Top, yeah, kind of bottom. Same thing here, top, bottom. Top, bottom. Top, and this is where the bottoms are here. Top, bottom. I'm gonna skip this because it was a wide range. Again, top, bottom, and on the other side as well. Top, bottom. Okay. Top, bottom. Top, bottom. Okay. Top, bottom. A little bit not perfect. And you can't do this on the down move. So you have to go back to the other time that markets were up. And so now we're looking back all the way to 2007. And lo and behold, look at this. Top, bottom. Top, bottom. Top, bottom. Top, bottom. This one you can't. And again, nothing is perfect, as I said. Top, bottom. Here, top, bottom. How about this one? Very nice. And I think the further out you go into the past, the less the price fluctuated in the SPY. And also I don't want to bore you to death here, but the point being is that you are seeing very similar moves here. Okay, so that's that. Now the other thing I want to show you, let me zoom out just so you get the context of it. So this is where I drew all the lines in. Notice how many times we've seen this over and over and over again. We've seen it here as well. Now of course if I went back I could have found a lot more here, but I didn't want to do a 3-hour video. But the point is that this is more common than not. So it's a very common occurrence. There's also something else I want to show you. And this one is if we look at the 200 moving average, which is this red line. So for that one I'm going to make a red arrow. Okay, give me one moment while I do that on my other monitor. Okay, so how about if we do the same thing that we just did with the blue line, but instead of going from resistance to support, let's go from resistance to the 200 moving average. And this is where the blue line originated, and therefore to control for this semi-experiment, let's start from the same candle, right? So what can we say here? Okay, it's the same thing. If you superimpose it on the 200 moving average, you will find that price rarely gets too far away from the 200 moving average. Again, you can keep doing this over and over again, right? I don't want to bore you, but that's the point. That price is rarely going to get above that 200 moving average by more than whatever the length of this arrow is. Okay, so you have one here. Again, notice how consistent this is. And again, you can fast forward here as well. But the point is that I'm going to show you a lot of these. Sometimes you overshoot, obviously. Nothing is perfect, as I keep repeating. Okay. Again, notice how I'm only doing that for the upper ranges, so I'm not testing this when price gets below the 200, only when it gets above, which is what we're trying to test. We're trying to find out how far price can go because we just hit these all-time highs. Okay, not much going on here, but again, I think this is because we're sort of probably changing the direction of the market. So again, you can only use this on the upside. Again, not perfect. Notice how here we did go above, but we eventually came back. So I think this is probably one of the down moves. Okay, but let's just, for the sake of it, let's try it here. And of course, the further out you go in time, the more likely it is to fall apart. So if you were to do this test and you go back in time, it's going to be more difficult to repeat these same results. So just keep that in mind. So notice how now we have fewer and fewer of these, and it's more difficult to find them. And again, this is the downtrend, so I don't want to do it here. But again, let's zoom out and see what the heck I just did. And here's what I did, right? Notice all this that's going on, right? So you see the lines more than you see the candles. So this doesn't even look like a candlestick chart anymore. But again, that's because this is very, very common. Notice how many examples we have. And also keep in mind that when you have these arrows, if they happen to be on the same candle, you're only going to see one color, right? And so if there's, for example, a blue underneath a red and they happen to coincide, you're only going to see one. So there's going to be a lot more arrows than you actually see right here. So if we fast forward to today, the question now becomes, well, how can I apply this example to what's going on in the charts today? So if I do the blue line, which is the support to resistance arrow, and I put it at the latest support area, which is right here, notice that we have overshot the resistance level. Therefore, we are in a danger zone. If I do the red line, which again is the 200 moving average, to the highest level, that one tells us we have some more to go. So again, where would that put us in terms of some potential resistance? So clearly we've overshot the blue line, so it is possible for price to come back down. But if it continues higher, we can go higher up to this 213.50-ish level, right? And again, it's not going to be exact, but the 213.50 to 213.70 level. So there's a lot of levels that you can keep in mind. Okay. So here's some of the newer ones. Remember in the first segment we talked about the 211, 212, and then the print at 212.97. So now we are in the area of the 213.50, although I think it's more like 213.60 to 213.70. And ultimately, I think the next target, based on what I did a couple of months ago when I calculated this, is the 214 level. So if you continue further, these are some key resistance levels that I will be looking at. Now the market, as I have been saying, is extremely overbought, and initially what I thought we would have, and again that still stands, what I initially thought we would have is a pop right into, from what I'm seeing now, is we popped into all-time highs, but then some sort of pullback, and then probably another pop higher. So what I'm thinking is, based on technical analysis, if you were to have a pullback and then shoot higher, this has to take out whatever that pivot is, whatever we're forming now, if that is the case. And so even if it takes it out by 1 cent, it's going to be valid. And then the next idea is that we would have a drastic sell-off. And I really mean drastic. So beyond the October lows. So that's what I'm thinking. Now, I will say something though. If we start selling immediately, so if this doesn't work out, and if we start selling immediately, okay, but that also implies that we would continue higher, right? So instead of having that pullback, if we continue higher and then we sell back, so in other words, that's what I mean by selling immediately. I think I misspoke. But if we continue higher without a pullback and then go down lower, it's going to be more drastic than what we're anticipating. And this is kind of the fear that I have, because if that happens, if we don't have a pullback, then that would mean that there's actually something wrong in the fundamentals as well. When you continue rallying and rallying and rallying without a pullback, that's actually not good for the markets. The market has to have some sort of pullback to gain a healthy momentum, right? So that it can then reload and go higher. Because we have to think about it in terms of the entire year. I'm trading right now. I'm day trading. That's great. If I swing trade, I hold a position for maybe 3 to 6 days, but that's it. But at the same time, I'm still a member of this society, right? Just like anybody else. And even though the most money is made when the market goes down, you kind of have to stop and think a little bit. If the market just keeps rallying and rallying and rallying higher, that is characteristic of major bubbles, right? So I would think that for our own sanity, next week we have some sort of pullback, okay? Because that's going to be better for all of us. If the market just keeps rallying and rallying higher without a pullback into next week, then that is going to signal, although you can't just base something off of 1 week of trading, but that is going to at least in my mind pose the question whether there is something more serious out there going on, whether in the US economy or in the global picture that we are not aware of. The technicals are saying we're going to have a pullback, so everything is overbought. So again, take a look at the 120-minute chart, because that one is extremely bullish. And if that one gives you some sort of signs for a reversal, then you have a better chance. Yes, you can look at the 15-minute, the 10-minute, the 30-minute, but all of that is intraday. So for this market, you want to see signals that you're going to reverse at least on the 120-minute chart, maybe even higher. Okay, so that's all I have. Unfortunately, next week I won't be posting a lot. I will be on vacation enjoying myself. I do these every once in a while. I need to take a break from trading sometimes, and that's what I'm going to do. And I will be checking my positions. So most of the times um, in the last couple of weeks, I have been day trading most of the time, so I've only been using that account. But I have kind of engaged a little bit in terms of my swing trading, so I have added a little bit, and I keep adding and adding. I don't add everything at the same time. And so today, when I saw what was going on with the markets, I went ahead and I bought some puts, just into next week, and hopefully that will pay off. But again, I think if you're patient in this market, if you give the market some room, okay, if you can afford that, to give the market some room, then you can make a lot of money. I think based on what I'm seeing now, we have to have some sort of pullback, and therefore I have added to my positions, and I think it's going to pay handsomely while I'm on vacation. But again, be responsible with your money, do your own research, and everybody can be wrong. Just like I picked up some VXX yesterday and then it went lower, and then I had to kind of reposition myself, so I got out of the VXX and I bought something else. But either way, I still think that we are going to have some sort of pullback. Now, how large the pullback is, I don't know. But if you're a long-term investor and you can give it some time and you kind of slowly position yourself instead of rushing into these positions, I think if you can kind of do that and then wait for probably mid-March or something, we're going to start seeing some cracks in this market, and therefore we should see some pretty good downside. And of course, when you're a trader, that's when you're making the most money. So as long as we have some volatility, again, this week wasn't really a great week when you think about it. We were just basing sideways, and today we sort of semi-broke out. But again, percentage-wise, not that much. So we need to see some of this volatility come back, and I have no doubt that that is going to happen. A lot of the things we've been hearing in January, none of that went away. So all we need to do is hear about it again, and I'm sure there are going to be some other issues that we're not aware of that we're going to be hearing about soon. So don't get swayed too much when you watch the news. Keep your own sanity, do your own research, and that is ultimately how you make money.